Okay, in Chapter 8, we're going to cover accounting for fiduciary activity, which mainly includes agency and trust funds. In this chapter, we're going to cover some of the common characteristics of fiduciary funds. We're going to cover agency funds, specific type of agency fund, the most common, tax agency fund. We're also going to cover trust funds and the three types of trust funds. There's private purpose trust funds, pension trust funds, and investment trust funds. And lastly, we'll cover under GASB the financial reporting requirements for fiduciary funds. Okay, so some of the common characteristics of fiduciary funds. They account for assets held by the government on behalf of another government, individual, or private organizations. These assets don't belong to the government holding them. They can't be used to support the government's own programs or citizens like other types of funds. The main difference between the agency and trust funds, or the types of fiduciary funds, are that the degree of involvement by the government that holds the funds, with the trust funds having much more involvement by the government that's holding them. Agency funds, one of the types of fiduciary funds, they most of the time involve receipt and disbursement of assets over a short period of time. They hold resources in custodial type capacity for others. And a tax agency fund is by far the most common. These funds collect taxes or other revenues by one government for another government or for many other governments. Examples of this are sales taxes, property tax, gasoline taxes, where the tax is collected centrally and then distributed to the benefiting funds or other governments. For instance, your property taxes that are owed for your real estate or even sales taxes, most of the time have a component, like property tax has a county component, a city component, and a lot of times these special assessments for various school systems. And so these are collected at one point, usually at the county level here at Jefferson County, and then they're distributed out. So they use a tax agency fund to accomplish that. Same thing for sales taxes. They always have like a state component to them. Let's say it's 8% in the city of Harpersville, which I happen to know off the top of my head. There's a 4% component of that is for the state of Alabama, and a 4% of that is for the city of Harpersville. Tax agency funds charge other funds for collecting taxes and recognizes this fee as revenues, while those other funds that pay that fee recognize that fee as an expenditure. Trust funds, on the other hand, they have more involvement by the custodial government than just collecting and distributing like agency funds do. There's more administrative and financial control of the resources by the government. They can invest it more, things like that. And I say investment because these assets are held for a longer period of time. These trust funds account for assets received by the government in a trust agreement, which the assets are to be invested to produce income to be used for a specific purpose, that is, to benefit those outside the government. The first type of trust fund I'll talk about is a private purpose trust fund. Example of these, they account for, some private purpose trust funds account for unclaimed property or escheat property. An example would be an estate of a person who had died, but they had no known heirs. Their unclaimed property, such as bank accounts, investment accounts, payroll checks that were never cashed, etc., those will be accounted for in a private purpose trust fund because they are for the benefit of either a private organization, private individual, or other government. On the other hand, this is in contrast to public purpose trust funds. These aren't considered agency funds under GASB because they benefit a public purpose by definition within that government. And so there's two types of public purpose trust funds, again, that don't fall under the definition of agency fund. There are non-expendable public purpose trust funds. These are accounted for as a permanent fund. And when I say non-expendable, that means the corpus of the principal, the endowment, can't be touched, only the earnings from the endowment. An expendable public purpose trust fund where the endowment can be spent, those are accounted for as a special revenue fund. The next type of trust fund are pension trust funds. These are the most common. They hold resources in trust for employee retirement plans and other employee benefit plans for employees once they retire. The resources are held and invested and used to pay out benefits to retirees. You guys cover more about accounting for pension funds in your Intermediate 3 class, but this is a big deal if you're paying attention to the news these days, as several states are including Alabama, although not as significant as some like Illinois, but are significantly underfunded in their state pension plans. And I don't know what they're counting on to start altering benefits. Maybe they're counting on a federal government bailout, of course, which seems to be pretty common these days. But there are several states in real trouble, so it's an interesting subject to stay informed on as things play out in the news. And finally, investment trust funds. These are created when multiple governments or organizations pool their resources together under one investment manager. And the purpose of this is assume that you can reach some economies of scale by doing that. The University of Alabama system has an investment pool that all its member institutions and foundations and things like that can participate in. They're not required to invest there. At least the foundations aren't. Management of investments are enhanced when they're placed underneath one professional investment manager. And the resources of the external participant in the investment pool are accounted for in investment trust funds. And I stress the word external there because in the participating government or the administrating government can and does participate in the investment pool, but those resources are considered internal to that government, so they are not accounted for in investment trust funds. They are accounted for in governmental fund. In terms of the reporting, the activity and the balances and everything for an investment trust fund is only reported in the fiduciary fund statements. They're not reported in the government-wide statements. The financial reporting requirements for fiduciary funds, they have an economic resources measurement focus, which again means they use the accrual basis of accounting, not the modified accrual that governmental funds use. They're only reported in the fiduciary fund financial statements, where assets equal liabilities. There's no equity because it belongs to someone else. These resources do. And that's why they're not reported at the government-wide level, because the resources held by these fiduciary funds are not the resources of the government, and therefore they can't be used to support government or its operations. The required financial statements for agency and trust funds. First, with the agency funds, they're only required to have one statement, and that's a statement of fiduciary net assets. And there is no change in statement for changes in net assets or anything like that, because of course assets equal liabilities in an agency fund. For trust funds, there's also a statement of fiduciary net assets. It's similar to a balance sheet, but there's also a statement of changes in fiduciary net assets that's similar to an income statement. And the labels of the different sections of the income statement or statement in fiduciary net assets, it changes, are additions rather than revenues. And these additions are contributions by participants or earnings on the principal. And the deductions section, instead of expenses, these are expenses that are incurred by the fund, like management fees, things like that, investment management fees, as well as payouts to the participants in the fund.